You just got your bonus and it's been sitting in your savings account. And every time you think about investing it, you pause because it feels like it deserves a big decisions, right? So you do nothing. I'm an actuary. I spend most of my time thinking about risk and trade offs. And I've had my money sit like this too. So this is how I think about it now if the goal is actually building long term wealth. One thing that helped me is deciding this before the money even shows up. So when money hits, it already knows where to go. And yeah, I'll probably still spoil myself with a small part of it. I mean, that's kind of the point of a bonus. But here's the real question that comes next. How do I put this money to work as effectively as possible? And assuming the basics are all covered here, like the emergency fund, no high interest debt, maxing out the tax advantage account, and you have the mortgage math figured out. Here comes the real first question. Do I invest at all or spread it out? My instinct used to be to spread it out. It felt more careful and less like a gamble. But one mistake I've made is I had a stock I feel really good about. I've done all the work and believe it's undervalued, but instead of buying it, I spread it out over a few months just to be safe. And turns out I kept buying just at worse prices each time. Nothing dramatic about it, but looking back, the thing is, there wasn't really a reason I didn't just buy it, other than it felt like a big decision. Research actually shows investing a lump sum all at once beats spreading it out roughly two-thirds of the time. That's when I realized spreading it out often just create a false sense of security. It's like deciding to eat your meal one bite per hour because you're not sure if you're hungry. Markets tend to go up over time. So the longer my money is invested, the more time it has to compound. So every month I wait, I'm implicitly betting that the prices will be lower later. Most of the time they aren't. So here's what to remember. Waiting feels safe, but at most time it really is just market timing in the pessimistic direction. Now, what about DCA? You'll hear this all the time. Just dollar cost average, it's the smarter and safer approach. This is where I used to confuse things. I thought spreading things out automatically means I was being disciplined. But DCA actually assumes one very specific situation. It's when money comes in gradually, like your salary. Then you invest gradually. There's nothing to time here. Making it a consistent thing is the whole point. But if I already have the money and I choose to spread it out anyway, I'm just buying myself time for no reason. So if you're investing in index funds and it's the money you won't need for a few years, data shows it's better to just go all in and forget about it. For individual stocks, if you believe something is undervalued, waiting doesn't reduce the risk. It just means I'm choosing not to buy something I already believe is a good bet. The only exception, if going all in would make you panic and sell at the worst time, then spreading it out can help. Not because it's optimal mathematically, but because behavior actually matters more than theory when it comes to investing. Now, the second question is, what am I actually buying? For me, there are two very different approaches. Index funds like VOO or VTI, that means one simple bet. The US economy will be bigger in 10 to 20 years. I don't need to pick winners. The system does that for me. It's like owning a sports team that automatically cuts out the worst players and signs the best one every season. You don't manage the roster, the system does. Individual stocks are different. Even when I feel confident, I'm actually making multiple assumptions at once. That the company will perform, that its edges will hold, and that the market will recognize it. And if I'm being honest, a lot of my past decisions weren't deep valuation. They're more like, I think this space matters, or I like this company. That's not useless, but it's not the same as knowing it's undervalued. So I treat these very differently. Index funds, I don't overthink. Just put in the money and move on. Individual stocks, if it's more of a directional bet, I keep it smaller. And I always ask myself, when would I actually sell this? If I don't have a good sense on that, that's usually a sign I shouldn't let it get too big. Now, third question, timing. And this is still the hardest part because there's always a reason to wait. Like tariffs just hit, there's a war going on, maybe the leaders are meeting in a few days and something will change. And then a few days later, there's another headline, another uncertainty. The decision keeps getting pushed. And somehow it always feels justified in the moment. But if you really think about what I'm saying when I say I'll invest when things feel better, what I really mean is I will invest when prices are higher, which is the opposite of being rational, because the best returns usually come before things feel safe. The S&P 500 recovers 41 days after a major geopolitical shock on average in history. And those 5-6% snapback days almost always happen within 2 weeks of the biggest drops. And the research shows if you had missed just the 10 best trading days in the market over the last couple of decades, your total return would have been cut in half. So the real question becomes, does this uncertainty actually matter over the next 10 to 20 years? For me, it doesn't. So stay in the game. All in all, here's what it looks like in practice when I have a lump sum of money. Debt handled, emergency fund intact, tax advantages accounts on track, then I'll invest it, and mostly into index fund. Selectively into individual companies where I actually have the conviction, sized based on how strong that conviction is. And on timing, I don't try to wait for things to feel right, because they almost never do. The framework isn't complicated. The hard part was just deciding it before things feel uncertain, so I don't have to figure it out when they do. And you don't have to get this perfectly right. You just have to get it consistently right. The goal is to make fewer decisions, not to make perfect decisions. And one last thing worth calling out separately. If your bonus is RSUs, just remember your income already depends on the company. So holding them is doubling down on the same risk. And not selling and redeploying it is an active choice to buy more of something that I'm not sure if you'd purchase with your own cash otherwise. Not necessarily wrong, but it's worth being honest that it's a decision. Most financial advice is built for the average person making the average decision. But you're not the average case. Your income is different, your exposure is different, and options are different. That's why the generic advice feels slightly off, because it wasn't built for your situation. And that's what this channel is trying to solve. If any of that feels like it's written for you, hit the like button and subscribe. And I'll see you in the next one.